Stocks, as Sonal was pointing out, I think the market open is up on your screen. Straight away, there was a tinge of green, now there's a tinge of red, but it's not very much at all. I mean, I think this is a very slow start, but 35 points lower is what you have in the Nifty. The Nifty Bank is down about 0.25%, is down 100 points. And what else? Mid-cap index is up about, mid-cap index is up. It was down about 1.5 yesterday, and I think the small-cap index is starting slightly higher as well. So it's a flattish to slightly lower start, but Sonia's got more rates. Sonia.
Well, thanks a lot for that. So let's kick it off with some of the big movers, right? We have the paint companies that will definitely be in focus. Grasim, let's take a look at that. 2% higher as it launches itself into the paint sector. But important to note what the other incumbent players are doing, whether it is Asian Paints, there could be sentiment downtick on Berger Paints, Kansai, Nerolac, some of the smaller guys. But I think Asian Paints is the one that could bear the biggest brunt, so down almost about 1.5%. Berger Paints down almost about 1% as well. Now, banks are in focus. Yesterday, there was large delivery-based buying in a lot of the private sector banks. Look at that. Axis Bank is up about 1%. HDFC Bank, ICICI Bank, all of these banks saw good delivery-based buying. SBI also had delivery-based buying yesterday, so that continues to see traction over there. The other big sector to watch this morning is the space sector, because the government has now allowed 100% FDI in the space sector. So a lot of stocks. Walchand Nagar is up 2.5%. MTAR Tech, Data Patterns, Apollo Microsystems, Bharat Electronics, Cyient, DLM. So Apollo Microsystems is up, MTAR Tech is up about 5%, BEL is up 1.5%, Cyient, DLM should also come up for you on the screen. Now remember, a lot of these stocks have rallied substantially, and it's not as simplistic as, 100% FDI coming in immediately. It's just sentiment up move at the moment, but keep an eye out on these stocks. Apart from that, let's take a look at some brokerage reactions as well. Paytm, look at that, 3% lower. Goldman Sachs has cut their target price to 450 from 860 earlier. I mean, it's still above the current market price. And some say that Goldman Sachs is a little late in the day to cut target price. But be that as it may, Paytm down 3.5% responding to that negative brokerage report. ABB, after the 10% up move yesterday, there's an additional 3.5% up move today. Jefferies has hiked their target price to 6,115, well above the current market price. They say order flow is very strong, so ABB is one of the big stocks in focus. Apart from that, South Indian Bank, there could be a rights issue coming, so keep an eye out on that. NBCC has gotten the nod to develop 5 Amrapali projects worth 1,000 crores, so 5% uptick there. Home First Finance, the IRDAI, has granted a composite license for soliciting life, general and health insurance. So Home First Finance is up about 3% And sugar stocks finally in focus as well, as the cabinet has hiked the sugar FRP, or the free remunerative price. So keep an eye out on many of these names. We were expecting them to be in the red, and they have played out. Now for the market overall, absolutely quiet, just buying time around the 22,000 mark. It's definitely a day of individual stocks. Back to you.
Well, that's right. And the big name coming into the paint industry, as we have been mentioning, Berger Paints is down closer around 2%, maybe feeling the heat a little bit, though, this announcement was made quite a while back. A couple of stocks that did see a lot of selling it towards the end of trade, they are bouncing back. Hindustan Copper is up close to around 3%. Keep in mind, the stock corrected close to around 50 rupees, or around 15-16% from the recent peak. That one's up close to around 3% as we speak. Another couple of notable movers, Sula Vineyards. The Maharashtra government has notified extension of wine industrial promotion scheme for around 8 years. That explains why that stock, one of the top movers today, up close to around 3%. Sale as well comes out of the ban, the F&O ban that it was in. So that explains why that stock had opened up with a green tick. You have IRDA as well as Hudco, both of them top volume movers today. Both of them up, I think, close to around 2%. And Geo Financial Services, just take a look at that name, on its way to around 300 rupees. Big move is what we've seen in the last month or so. Big move out there. I think it's up close to around 15-16% from the recent lows. Prashant, what else?
Okay, so quiet start, right? At least as far as the index is concerned. Just a 3-point change. So, flattish, absolutely flattish, nothing. Just a few other names, right? Sula, I think we just mentioned 2.5 higher. NBCC, there's news there. IRDA and ABB. ABB is up another 3%. A lot of brokers sort of saying that we'll go slow, and stocks are up and valuations are rich, etc. But 10% and another 3 this morning. We've got Campus, which saw a sharp move yesterday, 4.5 there. MTAR Tech is up 6.5. Brigade is up 3. Hindustan Copper is up 3. That's coming up with some gains this morning. So 250, 253 or so. Mishra Dhatu, Midhani is up about 4%. There is HEG, which is up about 4.5%, nearly 1,700 on HEG at this point. And there is Graphite India, which is up about 3.5% as well. Nelco is coming up with a big 7% pop. So that's 810 on Nelco. And there is Home First. There's news there from on the insurance side. That is coming up with a sharp 2.5% gain as well. So, that's essentially what's showing up on the gaining list. Paytm, I mean, basically had 4 days of 5% gains, right? A limit up, so it's down a little bit, but it's a top traded loser, top volume-led loser. Tourism Finance Corporation had a big move yesterday. There was a block deal, I think, day before. NHPC is coming up with a 2.5% cut. Berger Asian Paints are, of course, the losers. There's news there with a large competitor's brand getting launched. Bajaj Hindustan is down 3.5%. Balrampur is down 1.5%. You got Renuka, which is down 1.5%. So lots of sugar names coming up as well. FRP and cane has gone up, which means that it necessitates an increase in sugar prices as well. So that's news flow. 10 points on the Nifty, all told, with about 5 minutes of market open behind us. Ashwini Agarwal is with us, founder and partner at Demeter Advisors. Ashwini, good to have you with us here. Thanks very much for your time. You've been sort of at the margin cautioning us a little bit, right? Markets perhaps getting a little too ahead of themselves, exuberant, narratives playing out. Well, that is what it is. And, we're still in the grips of a very strong bullish phase, Ashwini. What's the latest? How are you thinking about what markets do from here? And will we get that pause? We've not had a pause, right? January, we got just a fortnight, very short-lived pullback pause, and then the market just took off, made fresh highs. What's your sense?
So, Prashant, absolutely right in that I have been a little cautious for a little while. And obviously, that's been very painful in terms of positioning for me. But if I look back and see how this rally has been and how this rally has unfolded, I mean, a lot of the good news is fully priced in. The point, however, remains that there is a huge amount of retail money that keeps flowing in via mutual funds as well as directly. And there is not enough supply of paper for the time being. So, that tends to kind of push up the valuations and the global narrative as well. What I hear from my friends in the broking industry is that a lot of emerging market players have not been overweight on India, and that's been very painful. Whereas the China trade has kind of worked against most of these funds, so they are scrambling to catch up, as it were. And if you see the QIP of a PSU bank and how it was subscribed a couple of days ago, that kind of tells us that money is looking to go in where there is some modicum of value. So what I'm trying to say is this: that valuations are full, but money continues to pour in. So there's no telling, how strong it gets. My expectation continues to be that we should see a pullback, a meaningful pullback, and I'll tell you why I say so. I think the earnings environment is turning a little more challenging. December quarter was very good, 24-25% earnings growth if you take the entire universe of 3,500 odd companies that reported for the quarter ended December. But that came on a very weak margin trajectory in the base period. Going ahead, I think the base period becomes a little more supportive in terms of margin. So the year-on-year growth will probably be a little bit lesser. Second is that the interest rate cuts that we were expecting through 2024 are probably delayed by a few months or probably not there. We don't know. I mean, if you just read through the language of the US Fed minutes released overnight, and if you think about the fact that US growth continues to be fine, unemployment hasn't really spiked up, inflation hasn't really gone down. I mean, what tells us that rates are around the corner? So I think the environment going ahead on a fundamental basis is a little more challenging. India has its growth behind it for sure, and there's money behind it. But my sense is that I would remain cautious, which I've done for the last couple of months, and I've been wrong.
Okay, well, that's humble of you and candid as well to say that you are cautious and you've been wrong, and you're not alone. To be honest, there are a lot of people who've come on our channel saying that this is the time to be cautious, but the market is just defied all forms of wisdom, right? Be that as it may, there are some spaces which have specific attention from the government these days, whether it is renewable energy, electrification of vehicles. Now, the space sector, right? The government just announced 100% FDI in space. They're looking for large investments from foreign investors. Do you think these are sectors that, despite the valuation challenge, could continue to see an up move?
Yes, Sonia. I mean, it's possible because, if you think about the three themes that the government is pushing very aggressively on, one is renewable energy, the second is defense, and the third is aerospace. And in defense and aerospace, it's not just for our domestic requirements, especially in defense. I think there is a very large export angle being pursued as well. So, the companies in this space might see significant opportunities. From a listed market perspective, however, I worry that, a lot of the valuations are very, very rich. I mean, I was looking at a company yesterday, can't name it, but where, literally 1 or 2% of the revenues might be from defense. And, people are telling me, oh, you should buy the name because, this is a play on defense. So, the euphoria from a stock market perspective is quite strong. The other thing I would like to put out there is that at least historically over the last 2 decades, whenever there is government involved in as a buyer or as a major policy driver, there have been delays and there have been disputes. I hope they don't arise this time around, but it's a risk worth considering when investing in a very high multiple name.
All right. Hi, Mr. Agarwal. Good morning and good to see you. When you said that you're expecting a meaningful correction. What could you quantify that? What would you quantify as a meaningful correction?
It's very difficult to say. I would think that, given the tailwind that the economic growth has and the kind of center of attention India is at this point in time, I don't think one can expect anything more than, let's say, 2,000 points on a Nifty, if you ask me to be a guessing man. So 8 to 10% is what I would think at this point in time. But, the point is that very often, we get the direction right and we get the quantum wrong. So the scenario of why this correction will occur is still to unfold. And how that narrative builds from there is something that remains to be seen. So, I just think that looking at the history of the last 25, 30 years, which is, where I've been tracking India quite closely, we've seldom seen strength in the market, which is as long and as strong as what we've seen over the last 10 months or so. And a meaningful pullback would indicate at least 8 to 10% pullback. That's what I think at this point in time, led by the mid and small.
Got it. If that happens, 8 to 10%, I've been keeping my SIPs going. I'll go for a little bit of a lump sum if in case that does happen. So we'll have to see how that goes. But the other question I wanted to ask you about this debate between the PSUs and the private sector banks. The PSU banks have made a lot of money, but the private sector banks are very, very well placed. At current, valuations at this juncture, what is your pick between the two?
It's a balanced approach because, the PSU banks at this point in time don't have the issue of asset quality that has been dogging them for the last, I would say, decade and a half or so. And they have very strong deposit growth. So they may be in a position to exploit the growth opportunities that are presenting themselves. But even in the private sector space, as you said, by and large, the stock price underperformance offers an opportunity from a medium to long term. I think the big one is HDFC Bank. And for due disclosure, I do own the name. So whatever I say has to be taken with that disclosure in mind. My sense, again, is that there has been a disappointment with the way the post-merger story has unfolded. But valuations are now getting to a point where it's quite compelling, though it might require a wait of 12 months or so before the numbers start to look a little more interesting from a credit deposit standpoint and a growth standpoint. So, it requires a little bit of patient investing. But if you were to look 3 years out from here, can you make a 15-20% compounded annual return on the private banks? I think the answer is yes. On the public sector side, the momentum is behind you. Valuations are reasonable. But again, history tells us that PSU banks tend to, get caught up in NPL problems and so on and so forth. So I don't know how this story unfolds this time around. But yeah, it looks good for now.
No, I take that point, Ashwini. By the way, the market slipped a little bit more. So we're down about 47, 48 points on the Nifty. Market breadth is also turned. I mean, it's too early to look at advanced decline and say anything definitive off it. But we got more. It's about 2:1 in favor of losers right now. Mid-cap index is down about 0.5%, and you got the small-cap indexes, which is down about 0.5% as well. And this is what I was saying in the morning. You need to assess, let the market tell you that what it wants to do. If it wants to negate yesterday just as a one-off, it has done so many times in the past. I mean, you'll get that signal from the market. I mean, 50, 60 points here and there will not change anything in the larger scheme of things. Ashwini, any idiosyncratic ideas that you may want to talk about? I'm not sure you want to talk about specific stocks, but you've had a few accidents along the way, and that sometimes open up opportunities.
Yes, Prashant. I mean, I don't know if I want to go fishing in troubled waters because, the events that you're talking about, or the two names that you're talking about, they are being dogged by events which are not predictable by me. Okay, one has a serious regulatory issue, and the other one, again, has a serious allegation of fraud. So how these things unfold is anybody's guess, and I'm not going to venture near them. And that would be, my take on those two names. Having said that, I think in the bottom-up scenario, what I love to look at as a theme is where earnings have underperformed, and one can expect things to turn around with a 1 to 2 year perspective. So I think one of the big areas where value is starting to emerge is the base chemicals or the upstream chemicals space. If you recall, over the last 1 year or so, I've been very positive about pharmaceuticals and downstream chemicals, saying that the pricing in the upstream chemicals will come off and the margins in the downstream side will get restored. Now, I think the time is to travel a little bit upstream because a lot of the bad earnings are already behind us. And from here on, I think margins will start to normalize and earnings growth will start to pick up. This is also the area where a lot of export opportunity exists for Indian companies, and they've been working to realize that opportunity. So that's a space that looks quite interesting to me. You mentioned financials, and we discussed them. That's the other space, though I would suspect that the returns are going to be reasonably mediocre, I would say, or say 18 to 20%. I don't think that's mediocre. That's fine. Those kind of returns can be expected from financials. So, those are the two areas on a bottom-up idiosyncratic basis sector-wise that I see as providing opportunities to us at this point.
Okay, all right. Thanks a lot, Ashwini, for joining in and filling us in with your view on the markets. We look forward to having a chat with you in the time to come. Well, for the time being, though, let's move to a CNBC-TV18 exclusive. Indian Hotels Company, well, that's in focus. The stock is up more than 80% in the last 1 year. The company reported its best ever revenue, EBITDA, as well as margins in Q3. The question is, what's the way ahead? To discuss this and more, we have Mr. Puneet Chhatwal, the MD and CEO of the company, who joins us on the show. Hi, Puneet. Good morning. Always good speaking to you. Well, let's get a couple of aspects out of the way. Q3 was splendid. How's Q4 shaping up? And what's the way ahead, particularly on the ARR front? Your shareholders are cheering, but we are bearing the brunt, I think. Tell us more.
Morning, Nigel. I think the sector is in for a very long innings. And if we are getting close to a century, I think you can expect double or triple because there is an imbalance between supply and demand. While demand remains strong, the supply remains constrained. That's number one. And number two, in the case of Indian hotels, are not like-for-like growth is very strong. We indicated we'll open 20 hotels by the end of this financial. I think if we add our recent tie-up with Tree of Life, we could say easily we are at 30. And going forward, I don't see this number getting less than 2 to 2.5 hotels a month in the next fiscal. And as most of it is driven by Management fee business, I think we just keep adding to the top line and we keep adding to the margin expansion, and eventually the flow through remains stable.
Puneet, hi, good morning. And as always, it's great speaking to you to understand trends in the sector. Now, the whole wedding business has been booming, right, over the last couple of years. Especially now, it's one of the best in the last many years. And Prime Minister Modi has come out and encouraged people to sort of get married in India rather than go to places abroad. But we all know that the inventory, as far as hotels are concerned, is very limited. In fact, not just for this season, but even for next, hotels are completely sold out. So are there new areas, new geographies which are opening up where you see potential and where perhaps the industry itself can sort of put more money to work?
Very good question, Sonia. I think generally speaking, forget just wedding, I think India has changed and is changing very rapidly. Just think where we were 20 years ago, where we were 10 years ago, and where we are today as the fifth largest economy, and very well poised to become the third largest in 6-7 years, which has a lot of implications because what is driving this is your GDP growth, which means increase in per capita income, which means increase in employment, which means increase in discretionary spend. So having said that, the direct and indirect beneficiary of this is obviously one of the beneficiaries is the hospitality sector. Having said that, number two, there is more and more shift towards spirituality. And a lot of people are including that, driven by defining purpose in their organizations. So spirituality is gaining prominence. And I think India does offer a very wide range and a very diversified range of spiritual opportunities. Third is, as you said, weddings. That is a cultural thing. Wedding in India is a celebration. It's a social event, not necessarily related to just the couple that is getting married. So that is there to stay. And finally, more and more, as you said, wed in India. I think it's also was heal in India. There is opportunities for medical tourism. And finally, the fifth point is we are still far away from the pre-COVID foreign travel arrivals. At some point, that is going to level off and increase than what it used to be. And I think all these factors make hospitality sector uniquely positioned in the next short-term, mid-term, long-term,
Sure.
I would say in all possible phases.
You spoke about spiritual tourism, right? Currently, you have hotels in over 50 temple towns. Would you be looking to expand your foray in the spiritual tourism space? If yes, can you give us some details on what the next 12 to 18 months could look like?
A lot, Sonia. We just opened last week our second hotel in Tirupati. We have signed 3 in Ayodhya. We are in Haridwar. We are in near Rishikesh, which is called Anand Kashi on the Ganges. We have the Taj in Rishikesh. We have 2 hotels in Katra. We are in Madurai. The list can keep going on. I think very important is the spiritual destinations, with the exception of COVID, are really crisis resistant. People go there for a variety of reasons. People go there out of joy. People go there out of sorrow. People just go there because it's a part of your culture and part of some of the things that you are taught to do in your spiritual education. So I think the more we can get, the happier we are. And also not just Taj, to extend it from ginger positioning till Taj and whatever else comes with it. I think this diversified brandscape will really help us to support spiritual tourism in the years to come.
Puneet, hi, good morning. A couple of questions. In Ayodhya, with all the inventory, how many room keys will you have? How many rooms will Taj have?
See, at the moment, we are close to what we have signed up. We are close to 350. But what we have in mind is around 750 keys over the next 5 to 7 years, because we still have to cover the Taj brand. We are there with the 3 other brands, plus the new brand that we will launch, and the new platform that we have acquired with, or the collaboration with Tree of Life. So I think if I add all of them up, we should get close to 750 keys.
750 keys over the, I mean, by the end of 3 years, right?
At 3 to 5, it may take time to build.
Okay.
It's not that easy. So something keeps happening. We would love to build it faster, but
Okay.
something changes. And so I would say let's take 3 to 5 years.
Okay. Just to go back to the question about room tariffs, average room rates. I think in the conference call you did mention that in FY25 ARRs could go up between 10 to 15%. That came as a positive surprise to many who were actually building in lower 5-6% kind of growth. What 10-15% on top of what we've already seen in FY24. So just talk to us a little bit about that.
Prashant, what happens is...
Yeah, and just want to complete that point, the fundamental issue is this gap between the number of rooms which are there and the demand, right? And the build-out has not happened. But just looking ahead, because you have a bird's eye view as well about the industry, by when does that gap start to narrow between availability of rooms and demand?
See, the gap cannot narrow fast. So that's the easiest one to answer because as I just now said for Ayodhya, for our own portfolio, it just takes time to build and finish properties. So that's one reality which we have to learn to live with. Important is what I said at the outset. The landscape has changed. If you become among the top 3 economies of the world, the consumer behavior also changes. The consumer behavior cannot say the way it was when you were number 20 or number 15 and number 10. So I think there will be a constant evolution of consumer behavior, and this sector from being perceived more as a luxury or discretionary is very rapidly moving towards becoming a consumer sector. It's more like a need sector. So if you travel to places, you need a place to stay. It's not just for leisure. For business, as our tier 2, tier 3 cities open up, as there is doubling of airports, as there is renaissance of train stations, all this and the investment generally in infrastructure is going to drive a lot of supply, but that may take next 5, 7, 10 years to come. But there is nothing that suggests that the corresponding increase in demand will not be there. So supply is definitely needed and more supply is needed, including in metros. But the demand will continue to increase too.
Okay, all right, Puneet, you're sounding so optimistic about the ARRs going out. I think I'd rather focus on Ginger Hotels. Tell us, how is that brand shaping up? What's the current revenue you get from that brand and where is it headed? And also, you've recently opened the Ginger Hotel here in Mumbai. What's been the response?
The Ginger Hotel in Mumbai, months to date, is almost at 90% occupancy, edging every day closer to 7,500 rupees achieved rate. We are very pleased with that. We are thinking just that hotel has the potential to do 100 crore revenue next year in the next financial, which will be its first full financial year. And hotels like those are expected to drive margins north of 60%. So I think we are all in all very pleased with the reimagined Ginger, which is, we have also given that guidance, which is expected to do revenues north of 600 crores in next fiscal. And it's one of our fastest growing and profitable business after the Taj brand. Now, I would suggest to you to try that property and brunch on a Sunday. But please don't forget your Taj, because that should stay close to the heart of every Indian.
Absolutely.
Well, we are waiting to try all of this and more, right? I mean, it's clearly wanderlust is what we feel now. Given, I mean, there's so much FOMO about travel these days because things are picking up in such a big way as well. So thank you for that recommendation. But any fundraising plans from your end? Any acquisitions that one can expect on the anvil?
We are very well positioned. We are a net zero debt company. We have a healthy amount of cash reserves. Anything that comes up, which makes sense, we will definitely look at it, but only on the Indian subcontinent. We are not going to invest when the growth is happening here, the action is here. We are not going overseas and investing monies in other geographies of the world. And on the statement Nigel made on being optimistic, you know, this is across the sector, across the globe. All companies are announcing record quarters, record financial years. And at the outset, I think I was asked, how does Q4 look? Also by Nigel. It is moving in the same direction, including the Q1 of the next financial year.
Okay, all right. Puneet, always good speaking to you here. Thanks so much for joining in and giving us all of those details. Wishing you all the best and we look forward to having a chat with you after the end of this fiscal as well.
Thank you. Thank you.
We'll slip into a short break. On the other side, we'll have the management of Mahanagar Gas who will be joining in to detail the past quarter's numbers as well as guide us on the way ahead.
Welcome back. Mahanagar Gas is the management that we're going to talk to right now. The company reported a strong set of Q3 numbers. The volume growth was in line with estimates. The stock has surged 71% in the last 1 year. To discuss more on this, Ashu Singhal, the MD of Mahanagar Gas, is with us. Ashu, thanks a lot for joining in. It was a margin-led beat this time around. Your margins almost at about 29% right now. On a quarter-on-quarter basis as well, things have looked good. Just wanted to start by asking you, while your peers have seen either a decline in volumes or margins, you have been able to do better than what the street was expecting. What led to this? And if you can tell us, what is the kind of trajectory that you hope to maintain in margins going forward?
I think the margins are healthy as compared to the last fiscal. And this year, Q3 has been good. And we expect that Q4 will be in the similar range, or maybe slightly lower than what Q3 has been. As you asked about peers and how we are doing better than the peers, that they're actually company to company it varies. And if you talk about IGL, there have been pressure of electric vehicles there, and the government policy is very strong, and some of the volumes have come down in IGL. On the other side, we have been taking several steps to see that the volumes pick up, and the pricing have been also on the lower side. So all these things put together, we think that the MGL is in the good space.
So can you give us a number on the margins? What are you looking at, say, in Q4? And also, last time you had upgraded your EBITDA per SCM guidance from 8 to 10 rupees to about 10 to 12. Given that you had a beat this time in your margins, would you want to scale that EBITDA per SCM guidance further?
Yeah, I think it will be slightly higher because if you see the 9 months result, we are 13.5 rupees per SCM, EBITDA per SCM. And going forward, we expect it to be slightly, earlier we expecting 10 to 12 rupees. Now it may be 12 to 13 rupees is the range we expect the full financial year.
Mr. Singhal, hi, good morning. Could you tell us a little bit about what kind of volume growth we should expect in FY25 overall company-wise?
Yeah, this year we expect around 5% growth over the last financial year. And the next year, we again think that 6 to 7% will be the numbers from current 23-24. Because several schemes which we have launched in September, October for conversion and new purchase of vehicles, some of it schemes are there for bridging the gap between diesel or petrol vehicle and the CNG vehicle. So that will come into effect, and also the infrastructure is improving. We are building new CNG stations across the thing. New domestic connections are getting up. So we think that industrial and commercial again has been a good segment where we have added new industries in Raigad area. So we think around 6 to 7% will be the target for the next fiscal as compared to this financial year.
Mr. Singhal, so volume growth will be steady, 5-6% as you say. What about, if you read some of the global stuff on natural gas, etc., there is a there is a bit of a glut expected sometime down the line in 2024, 2025, right? How is that? How can that change dynamics for you here in terms of sort of pushing costs lower, driving more volumes? Is that possible? Have you seen that in the past whenever there has been a glut? And when that happens, that usually lasts for a few years.
When you see a glut, it means the oversupply of gas, or
Yes,
rather
oversupply.
that is conducive for the industry, because we have seen in COVID and the war era when the prices have shot up, and that has slightly shaken up the confidence of the transporters as well as industry and commerce. But last 1 year or so, we are finding that the prices are more stabilized. So in case oversupply of gas happens, and it's good for India because India is importing more, around 55% of LNG. So that sounds good for the country, and it's good for the CGD industry also as such.
Okay, all right. Hi, Mr. Singhal. Always good speaking to you. So we got this volume growth of around 6-7% for the next year. Unison, that's the one that you'll acquired, and I think the street was very optimistic. I remember, the street celebrated when you bought that asset. What is the contribution in volumes as of now?
Currently, it is around 1.1 MMSCMD against, 0.1 MMSCMD as against 3.7 MMSCMD of MGL. But in around 7 to 8 years, we think it will be more than 1 MMSCMD going forward, and we are assessing the situation. Recently, the regulator has given the approval, and all 100% shares have been transferred in the name of Mahanagar Gas. So we have had our first board meeting of the new company after our takeover, and we are assessing complete situation on ground. We will be more aggressive with capex investment, creating infrastructure, and seeing that the company's growth trajectory is bettered or maintained at levels of what we expect it to be.
Got it. Okay, all right. So that's about it. You've mentioned that in the past as well. I wanted to know maybe a near-term trajectory, but we'll take that. You're in the process of ramping that up from around 0.1 towards that 1 odd. What about your diversification strategy? You have a collaboration for LNG stations. You're also talking about EV charging stations. Tell us, what is the diversification plan, point number 1, and how much capex have you lined up to diversify from your core business?
In diversification, few steps are being taken up. One is that we have formed a joint venture company with Baidyanath LNG for setting up LNG stations, and around 5 to 6 stations we are expecting to be set up in a 1 year's time. So that company is functional and running. One CBG plant, we are in final stages of concluding the concession agreement. Once that is done, then capex investment approval will be taken to the board for taking this project forward. It will be again a mega project for us. Related to the EV, we have recently announced acquisition of 31% equity in one of a startup company in Bangalore-based company. So that's a diversification which we have done very recently. And again, going forward, we will be looking into various opportunities which do come up, because again, we have been doing the core business of CNG and PNG and industrial commercial, but with CBG coming up, LNG station coming up, EV coming up, it is slightly diversified as a portfolio. We will like to consolidate that, and then going forward, we'll look for further opportunities.
But have you seen any change in market share? Is are electric vehicles eating up the market share? Because the trend was very good up until now, but in the last couple of months in certain pockets, like say two-wheelers, etc., the EV trajectory has moderated or slowed down a bit. What are you seeing as the big trends? And if you can also tell us this 15% conversion to EVs by 2025 in Maharashtra that was announced in the draft policy, you think that is that could be a reality?
I think EV has got their own set of challenges, starting with the type of electricity which is being used to run the EV is mostly coal-based, so that increases the carbon footprint. The other part is the FAME subsidy, again, is the scheme will be relaunched. Third is the availability and high capex. And fourth is that two-wheeler segment does not impact CNG business at all, because CNG is not being used in two-wheelers, and maximum of EVs are run in two-wheeler segment, followed by three-wheeler. Now, even if some of the part of share is going into three-wheelers will go to EV, that is well taken. Nothing to say that it cannot happen, and it's going to happen over a few years' time. However, it will be more than compensated with the type of infrastructure CNG is creating in terms of commercial vehicles, buses, and other heavy vehicles which can run on CNG or LNG. So in that respect, we have our strategy well in place about LNG also in LNG's retail station in addition to CNG station. So that will be more than compensating. That's how the growth has been coming, and we expect the same numbers in at least 5 to 7 years' time.
All right. We'll leave it there, Mr. Shingle. Great to have you with us here. Appreciate your time here on CNBC TV18 as always. Thanks indeed. That's the management of Mahanagar Gas MGL. Stocks about a 0.25% higher. Market, by the way, is down 40 points, so it's quiet. 22,018 or so. Now, in a bid to promote Maharashtra's wine industry, the state government is finally notified the continuation of the wine industrial promotion scheme for a period of 8 years. We have Mr. Rajiv Samant, Managing Director and CEO at Sula Vineyards, joining in to take some questions. Rajiv, great to have you with us here. Good morning. Thanks for your time. Prashant this side. I remember the last time we spoke and we asked you this, you were saying that you were just waiting for that notification from the government. Now it's come through. I'm sure you've taken a look at it. Is there anything different? Is it essentially what was there before? It was paused, the scheme was paused. And what does this mean for your business?
Yes, it's a big relief. It's something we've been expecting now. It's been sort of in abeyance since the last couple of years, which has not been easy. First, we want to convey our appreciation to the Maharashtra government for recognizing the importance of this industry. It's such an important industry in the rural areas, and it's really bringing pride to Maharashtra, to Nasik district, as well as to other districts. So this is great news for us. It's a big relief. It removes a lot of the uncertainty that was really hanging over our head. What we've seen right now, and we are going to be working on the fine print later, but for now, the way it looks, the scheme has been extended for 8 years. Please note that this is 4 back years where it had been held, which will now be paid in full, all those back dues up until March 24. And then for a forward 4 years after March 24 with a cap per unit. That's the first thing that we have seen. So really good news for us and for the wine industry as a whole.
Could you sort of explain how does the scheme work? What is the scheme in simple words? And you said you'll be paid arrears as well from the time that the scheme, it was halted. So what is that amount? What is that amount? So two-part question. Go on.
So in Sula's case, the arrears are around 140 crores. So very sizable for a company of our size, very meaningful, and obviously has been hurting our cash flow these past few years. Now this money will be due to us imminently. We expect a big chunk of it for us and for all the wineries to be paid up before March 31st. So that's really going to be a huge boost to our coffers. This scheme in a nutshell is for wineries producing wine where the grapes are grown in Maharashtra, the wine is produced in Maharashtra and sold in Maharashtra. So it's an all Maharashtra scheme. In that case, out of the 20% VAT that's charged on a bottle of wine, approximately 16% less some set off comes back to the winery. So it's a pretty big chunk of change. That's it in a nutshell.
So, Rajiv, hi, good morning. So, this 140 crore arrears, which you'll receive before March 31st, what do you plan to do with the money, A? And B, on this 20 crore cap for the VAT refund, are you disappointed with this cap?
So, the 140 crores, a fairly large chunk of that will go down towards repaying debt. Our debt right now is around 250 crores at about 8%. So, part of that will go towards repaying debt. We also have some fairly ambitious capex plans. We are planning on putting up a new low-cost winery, which will be possibly one of the lowest-cost wineries in the world to make our cheaper wines. We also have a lot of renewable capex lined up. So large part of it will go towards the capex. So that's basically how it will work. In terms of the cap, it's actually something that we are not surprised by. It was in discussions. We want to point out that there is a cap coming in for the future of 20 crore per unit. I'd also like to point out that Sula, we have 3 units under the excise definition in the state of Maharashtra. That's about all that I'd like to say on that so far. Overall, though, it's very good news.
Got it. So you said your debt is 250 crores and you'll use a large part of this 140 crores to pay off your debt. What about the rest of the debt? Do you plan to reduce it further through any means? And if yes, what is the comfortable debt level that you're looking at over the next 1 year?
So I must say that our debt level is very comfortable. On if you take a debt EBITDA ratio, we are below 1.5 today. So we are comfortable up until a threshold of 2. So we don't have plans at this point to repay our debt prematurely. We do have capex plans. We're going to need money for our capex. We have to expand. Sales are doing well. So we need more processing capacity. So, I think let's say if we repaid 50, 75 crores worth of debt, 200 crores of debt, that would be a very comfortable debt position for us.
Got it. All right. Hi, Rajiv. Good to see you. And again, what about the plans to diversify beyond the Maharashtra markets? Is there a plan in place? And how do you see this panning out?
Absolutely. So I want to point out that in this financial year, sales outside Maharashtra have been growing significantly faster than sales within Maharashtra. So that sort of diversification is already happening naturally. Karnataka is an extremely important market for us. And this year, sales in Karnataka have grown faster than sales in Maharashtra, and is also a very profitable market for us. Very interestingly, our fastest growing segment this year has been CSD. So it looks like our defense staff is gaining a taste for lower alcohol stuff, and we're very happy about that. It's something like an 80% growth in our CSD sales this year.
Okay, could you give us a number about how much is coming from outside Maharashtra and where do you see that number headed? Since obviously on a much smaller base, it's growing at a faster clip.
Our sales outside Maharashtra are approximately 60% of our sales. So Maharashtra is approximately 40%.
Rajiv, sorry, just to push on that point about your 20 crore cap. So it'll be limited to 60 crores right now with the 3 units you have. That's the way to look at it?
Yes, that's the way to look at it.
Okay, got it. The bit about the CSD business, 80% growth. I mean, it's got to be something other than, developing a taste for wine. Has it been introduced in more stores, or have you kind of pushed through in that market? Because it's sizable, the CSD market. Yeah.
It's very sizable. It's great to see. Yes, it has gone into a few more stores. Also, CSD has changed a little bit their buying procedures. They had put a lot of limits in place a couple of years ago, and now they have started to basically whatever the defense wants, whatever there's demand for, they are allowing those goods to flow. And that's definitely benefiting Sula. Sula is today the #1 wine brand by far in India. And, our defense staff, let me tell you that they love Sula. That's obviously showing in the numbers. It's becoming a very sizable part of our business.
Okay, cheers to that. Then, Rajiv, thanks so much for stopping by, and look forward to having a chat with you in the coming months. But for the time being, I think it's cheers to you and cheers to the team as well, doing pretty well as we speak. But I don't think we should get too high on that because the markets have moved to the low point of the day. We're down at the low point of the day. We barely managed to defend the 21,900 odd. You'll still say that it's still just a bit of a pullback in an uptrending market. But for the time being, the Nifty bank, the one that was leading us higher, that's the one that, in fact, is down close to around 400 points, and it's breached the 50 DMA. If you pull up the Nifty bank as well as the 50 DMA, the crisscross lines will tell you the picture. Yesterday, it managed to defend that mark, but as we speak, it needs to bounce. It needs to bounce from this vicinity of around 46,500 odd %.
Absolutely, and let the price action tell you that it wants to do that because, the impulse would be you run 100, go in, buy, and probably you'll get a bounce. But, if you want to sort of, because this feeling has been festering for a while that maybe the market at the margin perhaps needs to take a bit of a pause, etc., etc. So let the price action negate that, and the way to do it is to perhaps take out the previous highs. As far as supports go, the 20-day comes in at 21,800, which is about 150 points away from here. That's a 20-day simple moving average as of yesterday's close. Just some markers really putting out there. OMCs for the second day running are taking a bit of a knock. That's important largely because that's been the sheer momentum pack. IOC, HP, BP, all stocks ended 2.5% lower, and they're down by that much this morning as well. Sonia.
Absolutely. And ABB, right? That one after 10% rally yesterday is up 6%. Yeah. And in Jeffrey's note, they mentioned that renewables is a big growth area for ABB India.
Yeah.
So we traditionally don't look at ABB as a renewable energy company, but this is a big focus area for the government. So you add ABB also to that list, and 6.5% higher now. Jeffrey's has the target price of 6,115. So big mover coming in there. Let's do one thing. Let's take a quick break. On the other side, Mitesh Thakkar will be joining in for some trading strategies. Stay tuned. Welcome back to Corporate Radar. Mitesh Thakkar joins us now to talk about the markets, which, by the way, is undergoing a bit of pressure right now. The sensex is down over 400 points. Mitesh, I think this was expected to happen, right? 3 or 4 days we've had a strong run. Yesterday, the markets came off a little bit. But do you think that this could be one of those days where taking a fresh short position right now makes sense? Or is it too soon to take that call?
Good morning. I think, a couple of things have happened. One, we have broken the gap area, which was created on the 15th, 16th of February. And the intraday hourly and the 2-hourly charts have turned negative. So I think this could be a slightly deeper correction. So taking a short may not be an entirely bad idea. I think the stop losses are close to about 22,050 on the spot, which is about 120 points higher. So maybe you would want to take part short now. And if you get a 50, 60 point intraday pullback, then add on to that. And I think we might actually test 21,700 to about 21,650 zone. So I think that's the target area which I'm looking at. In the short term, I think it looks like a volatile, choppy, and a corrective kind of a market.
Okay, any stocks you want to give us? OMCs are under a lot of pressure right now, but anything that makes sense to buy?
So I had, in fact, one OMC as a sell call, IOC, I think, and in fact, all the 3 stocks, IOC, BPCL, HPCL are showing signs of profit booking. So IOC has broken down. That's a sell with a stop at about 184 and a target of 167 can be looked at. While Axis Bank is something, which is actually kind of defying the way the market is moving, and the individual pattern is also positive. So we'll take a tight stop at 1,086 over here and take a long for targets of 1130.
All right, Mitesh, we'll leave it there, but we'll have you back for more because the market's moving, and right now it's moving on the downside. So Mitesh saying that maybe a short perhaps is not a bad idea, and putting out levels there to trade that view. We'll take a quick break. On the other side, our special segment, it's the economy. Lata will get chatting with Ramesh Chand, member of the Niti Aayog, as farmers demand legal status for the minimum support price and resume the Delhi Chalo protest. Stay tuned.
Welcome to It's the Economy. The Chalo Delhi farmer protest has been held up for a couple of days because of one tragic death. Now that gives us some time to analyze what the farmers want and its implications for the fisc. The farmers have two major demands. One, that MSP be written into law as a right. And two, that the calculation of MSP, minimum support price, be increased by including assumed rent of owned land as well as some capital cost. Now, to understand the implications, I have with me perhaps the authority on the subject, Ramesh Chand, member of the Niti Aayog for Agriculture. Professor Chand, thank you very much indeed for joining us. Let me start with the second of the demand, because that is arithmetic. The cost MSP be calculated not by the A2 plus FL into 1.5. Let me explain. The current plan is actual cost into family labor multiplied by 1.5, that is 50% plus, to be changed to C2, which is comprehensive cost. Can you tell us how much more expensive, what is included in the comprehensive cost and how much more expensive it is?
As you mentioned, comprehensive cost include two things which are not there in A2 plus FL. They are, number one, imputed value of rent on own land. If a farmer is doing cultivation on his land, he is not renting in land, then the rent is, some rental value is taken, depending upon what is the rental value in the village, and that is added. The second item is that farmer has some machinery, he has his farmhouse, there is interest on this. We call it interest on fixed capital. So that is the second item. When we add these two to A2 plus FL, then it becomes comprehensive cost, which is C2.
Okay. And how much more will that be, sir, in terms of, say, per quintal or for the exchequer, for the fisc itself?
You see, it will again vary from state to state. In some of the state, rental value is very less. In some of the state, rental value is very high. Roughly, I can say that this cost will increase by something 25 to 30%.
You mean then that all of us will be paying at least 25 to 30% more for the rice and all the other commodities we buy?
It will vary from crop to crop. It will vary from state to state. I'm just giving you rough figures.
Oh, okay, okay. So that there is a inflation implication and perhaps a DA implication if this were to come. Let me come to the other part, the legal guarantee. Now, anyway, the government is giving that MSP to anyone who is willing to come and offer it to the government. Why is it making it mandatory? Something that the government is resisting. Anyway, they will spend that money.
If making something legal can assure that price to farmer, I think large number of countries who are dealing with the remunerative prices to farmers, they would simply have passed this law and go to sleep. You see, these things just doing by law, it doesn't work and it has a lot of implications. It also impart rigidity in the system. Today, country need rice, country need wheat, country need mustard, whatever. You never know that after a few years, people may prefer millets more rather than rice and wheat. In place of one oil, they prefer another kind of oil. In place of one pulse, they prefer another kind of pulses. If you are making it mechanically that it is like this and it is legal, then again you have to go to parliament to change this law that we want to give different kind of direction, which is consistent with what are the changes in demand. We wanted the resource allocation to change to the things which are now wanted more by consumer than what was the situation some time back. So you see, if you fix something legally, then whether it is demanded, whether it is desired or not, you are just bringing this rigidity in the system then the profitability element become artificial.
Okay.
But it is not supported by demand side, it is not supported by market, because legally you have fixed it. Therefore, whether consumer today want to consume that particular commodity or not, you are bound to give that price.
Oh,
So then you don't know what to do with that production.
Fair point. There were some people raising the doubt that if you make it a right that a farmer gets, 4,000 rupees per quintal for rice or, 2,000 rupees per quintal for wheat, then in that case, the trade will be afraid to buy below that price. And will that be an issue? If the ruling price is above MSP, then anyway trade will buy, wouldn't it?
Lataji, there are complexity in this, and first of all, I believe that in a democratic setup, when government has to go to voter every 5 years, the assurance of the government, प्रतिविधता जो है सरकार की, that to my mind is the real guarantee. That to my mind is the trust between voter and the government, and to my mind, farmers should not insist on making it legal. If government is willing to give assurance, they should treat it as a sort of guarantee that government is assuring us, and they will do it. And already I am observing that the government is moving in that direction. Coming to your question, whether trade will buy or not. If the price that is statutorily fixed is not supported by demand side factors, then trader will buy not the entire produce, they will buy some produce which will be purchased by high income consumers. When price goes high, you know that it is people at the bottom of the income pyramid who always who always have capacity to pay lower price. So those kind of consumer, 40% like that, it's not that trader will not buy anything. Trader will buy some quantity for which they feel that middle income consumer and high income consumer will pay the price which business feel is viable for them. But the other section of society, they will you will find that they will suffer. I want to give example. This is a very important question you have raised. You see, it has been tried in the past. It was tried in Maharashtra. It didn't work. But let me take more common example. People know about sugarcane, that sugarcane price is statutory. Some farmer leaders are giving example also that when you can make sugar price legal, then why you can't other prices? This year, the situation is such that international prices are higher from last 1 year. So whatever FRP we are giving, it is supported by demand side factors. But 1 year before, what was happening continuously for so many years, that mills are not willing to buy price which was announced by the states, state-wide price. We know in neighboring Uttar Pradesh, the areas of farmer accumulated to thousands of crores of rupees. Mill simply said, at this state-wide price, we will not buy cane. Then court has to intervene, Allahabad High Court, even Supreme Court has to intervene, telling millers that, okay, whatever price you feel you can pay, you pay that, but start crushing the cane. Later, we will see later on how to deal with it. And for several years, I know in this chair, I have been dealing with this issue of paying area to the farmers. They accumulated to thousands of crores of rupees. So if demand side factors are not supportive, you will find that trade will not buy entire quantity that comes into market, that is marketed surplus, because clearance will not happen. We have seen this in case of sugarcane. This year's situation is different. That's why we are saying that this should be kept flexible. If market can afford, okay, give higher price to farmers. If market can't afford, okay, you can then adjust it. So this is very important, that rather than mechanical equation for MSP, we should have some flexible approach.
Okay. So what do you think is the solution now? What might bring the farmers to the table? I mean, I don't see them shouting too much about their other demands, that farmers should get pension, that India should get out of the World Trade Organization. So, some of the demands are simply impossible to fulfill. If only the legal guarantee is fulfilled, there seems to be an agreement. What do you think is the likely solution?
Yeah, I will come to that. Again, I come to legal because this is very important issue. Did the government of India offer any guarantee to farmers that since 65 onwards, not a single grain has been sold below MSP if it was meeting the that requirement or the norm. Even norms have been relaxed to purchase quantity in certain situation that there was late rainfall, etc., etc. So first of all, as I said, that in a democracy, assurances work, and assurance is as important as guarantee. Now coming to your again
solution.
Very direct question, but can be solution. You see, there are two aspects of MSP, and I am one because I have studied agriculture who support system of minimum support price for agriculture commodities. So now situation is that one is that MSP should be given, MSP should be ensured. Nobody who understands the situation of demand and supply situation of agriculture
opposes it.
Deny that. The farmer demand are two. One is that MSP legal. The second, which is I think much more difficult, that they are now dictating that we will tell you what should be MSP. You get my points? That they want that MSP should be whatever you say A2 plus F multiplied by 50%, something more than that. Or they are asking now for C2 and adding margin of 50% and like that. So it is not that government of India is not willing to give MSP. They are doing all those things. It is about what should be that MSP. I have written a piece for Indian Express. They put it on online edition today. I think they told me that print edition will publish it tomorrow. So I have suggested something there. I have suggested something there which meet what farmers are saying, and there the position which I am taking is, suggestion which I am taking, making there is that as far as rental value of land is concerned, interest on fixed cost is concerned, that must be covered. So MSP must cover cost C2. Okay. Then the second aspect is that how much margin should be given on cost C2. Okay. Or that calculation can be done on a paid out cost, that is separate thing, but what margin is given over and above MSP, which I feel should be equal to cost C2. That margin which should be added to MSP, I think that should be left to an expert agency like CACP. In some year, like for sugar this year, they will find that giving even a 15-20% margin on C2 is possible. In another year, they will find that only 4-5% margin is possible. So if we move this way, then we can meet this demand of farmer that they want C2, not the other one. And also that then they should be agreeing to that margin, which should be decided depending upon market situation by a authority like CACP, and that should vary from year to year. It should not be like MSP that every year it is increasing. That component should be kept totally flexible. In some years, that can go even beyond 50%. If market situation is. So I think if we move this way, I also want to add two more things because they are invoking name of respectable Swaminathan Sahab. I said it on other channel that we organized a meeting with Honorable Swaminathan Sahab. Here is this Niti Yoga letter which we had written, and he was kind enough to come to Niti Yoga to discuss with us. So we asked him, sir, we would like to know on what basis you have arrived at this figure of 50% margin. And report also has some ambiguity. It doesn't clearly state that it has to be 50% on C2 or it has to be 50% on A2 plus L. It just said cost. So this is what I read in the report. So we discussed, I'm today sharing this with the viewers that that this was the first question which we wanted to have a view of such a person who did so much for agriculture.